There's a question that comes up more than almost any other in personal finance. Should I put my money in a Roth IRA or a 401k? And the answers you get online are absolutely useless. Half of them tell you the Roth IRA is the best thing ever invented. The other half tells you the 401k is the only real way to build wealth. Almost nobody gives you a clear side-by-side breakdown of which one you should actually choose. Today we're going to fix that. By the end of this video, you'll know exactly which account to fund first, why the order matters, and the specific situations where the answer flips. Because here's the truth most people miss. This isn't actually an either-or question. The winner depends on your situation, and once you understand the framework, you'll never have to wonder again. Let's get into it. The quick answer, then we'll go deeper. If you want the executive summary right now, here it is. For most millennials, the order should be 401k, up to your employer match first, then max out a Roth IRA, then go back and fill up the 401k. If you don't have a 401k match, start with the Roth IRA. That's the short version. But the reason behind that order matters more than the order itself, because your situation might be the exception. So stick with me. We're going to break down exactly how these accounts work, what makes each one win in different scenarios, and how to make this decision in a way that actually fits your life. What a 401k actually is, let's start with the 401k because most people think they understand it and most people don't. A 401k is a retirement account offered through your employer. The money goes in before taxes are taken out, which means every dollar you put in lowers your taxable income for the year. If you make $70,000 and put $7,000 into your 401k, the IRS treats you like you made $63,000 for tax purposes. That's a real, immediate tax savings. The money then grows inside the account, tax deferred. You don't pay taxes on dividends, you don't pay taxes on capital gains, and you don't pay taxes on growth until you pull the money out in retirement. At that point, every dollar you withdraw is taxed as ordinary income. The contribution limit for 2026 is $23,500 per year. That's a lot. Most people don't come close to maxing it. The big thing about 401ks, and this is the part that matters more than anything else, is the employer match. Many companies will match a percentage of what you contribute. A common arrangement is something like, we'll match 100% of your contributions up to 4% of your salary, or we'll match 50% up to 6%. The numbers vary, but the principle is the same. Your employer puts free money into the account on your behalf. This is the single best investment return you can possibly get. A 100% match is a guaranteed 100% return on your money before the market does anything. You will never, ever beat that anywhere else. If you take one thing from this video, even if you stop watching right now, it's this. If your employer offers a match, contribute at least enough to get the full match. Anything less than that is leaving free money on the table. What a Roth IRA actually is, now the Roth IRA. This account works in almost the opposite way. You contribute money that has already been taxed. There's no upfront tax benefit. If you make $70,000 and you put $7,000 into a Roth IRA, the IRS still treats you like you made $70,000. But here's where it gets interesting. From that moment forward, that money, and every dollar of growth on it is never taxed again. Not when it earns dividends, not when you sell investments inside the account for a gain, not when you take it out in retirement. You pay taxes once on the way in and then you're done, forever. The contribution limit for 2026 is $7,000 per year if you're under 50. There are income limits, but for most millennials, they won't be a factor. If you make under roughly $150,000 as a single filer or $236,000 married filing jointly, you can contribute the full amount. The other thing about a Roth IRA that doesn't get enough attention, you can withdraw your contributions, just the contributions, not the earnings at any time, for any reason, without taxes or penalties. So if you put in $20,000 over a few years and it grows to $30,000, you can pull out that original $20,000 if you need to. This makes the Roth IRA way more flexible than people realize. It's not just a retirement account, it's also a backup emergency fund. A Roth IRA isn't offered through your employer. You open it yourself at Fidelity, Schwab, Vanguard, or any major brokerage. It takes about 10 minutes online. I'll put a link in the description. The core difference. It's all about taxes, so the fundamental difference between a 401k and a Roth IRA comes down to one question. When do you want to pay taxes, now or later? A traditional 401k says pay taxes later. You skip the taxes today, get a deduction, let the money grow, then pay taxes on everything when you withdraw it in retirement. A Roth IRA says pay taxes now. You take the hit today, get nothing in return, but never owe another dollar of tax on that money for the rest of your life. Which one wins depends entirely on a single variable. Will your tax rate in retirement be higher or lower than your tax rate today? If you'll be in a higher tax bracket in retirement, the Roth IRA wins because you paid taxes at a lower rate now. If you'll be in a lower tax bracket in retirement, the traditional 401k wins because you skip taxes at a higher rate. That's the whole calculation. Everything else is detail. Why the Roth IRA wins for most millennials? Here's why. For most millennials, the Roth IRA tends to be the smarter bet. First, you are probably in one of the lowest tax brackets of your career right now. Most people earn more later in life than earlier, so locking in today's lower tax rate by paying taxes now is mathematically smart. Second, tax rates in the United States are historically low. Look at a chart of the top marginal tax rate over the last century, and you'll see numbers that would shock most people. 70%, 80%, even 90% during certain decades. The current top rate of 37% is, in historical context, on the lower end. The country's debt and deficit suggest taxes are more likely to rise than fall over the next 30 years. If they do, you'll be glad you paid them while they were cheap. Third, the Roth IRA gives you flexibility that a 401k doesn't. You control where you open it, what you invest in, and what fees you pay. A 401k locks you into your employer's plan, which often has limited fund choices and higher fees. A Roth IRA at Fidelity or Schwab lets you buy any index fund you want at rock-bottom expense ratios. Fourth, the tax-free growth on a Roth IRA over 30 or 40 years is just an astonishing benefit. If you max out a Roth IRA at $7,000 a year from 25 to 65 and earn 8% returns, you end up with about $1.8 million. All of it tax-free, not tax-deferred, tax-free forever. Compare that to a traditional account where you'd owe taxes on the same $1.8 million when you withdrew it. Even at a modest 20% effective tax rate, you'd hand back $360,000 to the IRS. That's the value of paying taxes now while your income is lower. When the 401k actually wins. Now, before you go all in on the Roth IRA and ignore your 401k, let me walk you through the situations where the 401k is actually the better choice, because they exist and they matter. Situation 1, you have an employer match. This isn't even a debate. The match is free money. A 401k with a match gives you an instant guaranteed return that no Roth IRA can match. Always contribute enough to capture the full match before you do anything else with your retirement money. Situation 2, you're a high earner now and expect to earn less in retirement. If you're making $200,000 in your peak earning years and you expect to live on $80,000 in retirement, you should be funding a traditional 401k. You're getting a 32% tax deduction now, and you'll only pay around 12% to 22% on withdrawals later. That's a real significant tax arbitrage in your favor. Situation 3, you want to lower your current taxable income for other reasons. Maybe you're trying to qualify for certain tax credits or stay below a particular income threshold. The 401k deduction can help with that. The Roth doesn't. Situation 4, you're behind on retirement savings and need to catch up fast. The 401k has a much higher contribution limit, $23,500 versus $7,000, which means you can shovel a lot more money into tax advantage growth each year. For most people, the answer involves both accounts, not one or the other. The question isn't really which one wins, it's which one do I prioritize and in what order. The optimal order for most people, here's the order that works for the vast majority of millennials based on the math. Step 1, contribute to your 401k up to the full employer match. This is non-negotiable. If your company matches 4%, contribute 4%. Get the free money, always. Step 2, max out your Roth IRA. Take that $7,000 limit and fund it completely if you can. This is your tax-free wealth building machine. Set up automatic monthly contributions of about $583 if you can swing it. Step 3, go back and fill up your 401k. After your Roth IRA is maxed, return to your 401k and contribute more, up to the $23,500 limit if your income allows. At this point, you're not just chasing the match, you're using the 401k as a high-capacity savings vehicle with real tax benefits. Step 4, once both accounts are maxed, open a taxable brokerage. This is the overflow account. No tax advantages, but no limits and full flexibility. useful for goals you want to hit before age 59 and a half, like a house, a business, or early retirement. Most people will never max out all three. Now that's fine. The point is the order. Why capture the match, then fund the Roth, then fill the 401k. In that sequence, your money is doing the most work for you per dollar invested. The Roth 401k, a quick note. Some employers now offer something called a Roth 401k. This is a hybrid that combines the contribution rules of a 401k with the tax treatment of a Roth IRA. If your employer offers it, here's the quick framework. You contribute with after-tax money, like a Roth IRA, but you get the higher contribution limit of a 401k. And importantly, the employer match still applies, though traditionally the match itself goes into a pre-tax bucket. For most millennials, a Roth 401k is a great option. You get tax-free growth on a much larger contribution limit than a Roth IRA alone allows. The downside is that fund choices are still limited to your employer's plan, and expense ratios may not be as low as a Roth IRA at Fidelity or Schwab. A reasonable approach if you have access to a Roth 401k. Contribute up to the match in the Roth 401k, then max out your Roth IRA, then go back to the Roth 401k for the rest. That way you get the tax-free growth on a bigger pool of money, plus the flexibility and low costs of an outside Roth IRA. The biggest mistake people make with both. Before we wrap up, I want to point out a mistake that people make with both of these accounts, because it's the most common one I see and it costs people enormous amounts of money. They open the account, put money in, and then leave it sitting in cash. You'd be shocked how often this happens. Someone contributes $7,000 to their Roth IRA, feels good about it, and then never actually invests the money. It sits in the brokerage account as cash, earning basically nothing while they think they're building wealth. Just contributing money to a retirement account doesn't make it grow. You have to take the additional step of actually investing the cash inside the account. So after you contribute, log back in and buy something. For most people, a total stock market index fund like VTI or FSKAX is the right move. One purchase, broad diversification, low fees, set it and forget it. Do not let your retirement contributions sit in cash. That's not investing. That's just saving with extra steps. Here's the bottom line. The Roth IRA versus 401k debate isn't about which one is universally better. It's about understanding what each one does and using both strategically. For most millennials right now, the order is 401k to the match, then max Roth IRA, then more 401k, then taxable brokerage. For high earners who expect to retire on less than they make now, wait more toward the traditional 401k. For low to moderate earners early in their careers, the Roth IRA is your single most powerful wealth building tool. And whatever you do after you contribute, actually invest the money, buy the index fund. Don't let it sit in cash. If you do these things consistently for 30 years, you will end up with more wealth than most Americans will see in their lifetime. Not because you're smarter, not because you got lucky, because you use the system the way it was designed to be used. The accounts are the vehicles, the investments are the engine. The time you give it is the fuel. You need all three. If this video cleared things up for you, do me a favor and subscribe. Net Worth Nation is built for people who are done being confused about money and ready to actually use the tools that build real wealth. Drop a comment below. Which account are you going to fund first? And if you have a Roth 401k option at work, are you using it? I want to know what's working for you. Your answers help me make better videos. Share this video with someone who's been putting off opening a retirement account. You might be the reason they finally get started. I'll see you in the next one. Let's build.